There is a stock sitting right now at $1.63. Most people have never heard of it. And those same people will be kicking themselves in 3 years. Because this isn't a meme stock, this isn't some crypto-adjacent nonsense. This is a real company producing a real commodity that the entire world is about to desperately need. And here's the wildest part. Wall Street analysts have price targets on this thing that are 40%, 60%, even 100% higher than where it sits today. But I'm not going to tell you the name yet. First, I need you to understand why uranium is the most misunderstood energy trade of 2026. Because if you don't get the macro, you won't have the conviction to hold when it gets volatile. Let's talk about the elephant in the room, AI. Every single major tech company on the planet is in a race to build the most powerful data centers ever constructed. We're talking Microsoft, Google, Amazon, Meta, all of them, consuming an insane, almost incomprehensible amount of electricity. Here's the problem. Solar and wind can't keep up. They're intermittent, they're unreliable. You simply cannot run a $10 billion AI data center on power that only works when the sun shines. So what's the answer? Nuclear. Clean, always on, incredibly dense energy. And governments around the world are waking up to this fast. The US has pushed hard for domestic energy independence, specifically trying to move away from Russian uranium imports. Europe is re-evaluating nuclear after its energy crisis left it exposed. Even countries that previously shut down reactors are quietly bringing them back online. And here's the thing about uranium. It's not like oil where you can just turn on a spigot. Uranium mines take years to permit and build. Supply takes a long time to respond. But demand? Demand is moving right now. This is a classic commodity setup. Demand accelerates, supply lags, price goes up. And companies that are already producing uranium, with mines already in the ground, get to capture every single dollar of that price increase. Which brings me to the stock. There's one small American uranium producer that most people have completely overlooked. It's already mining, it already has contracts, and it's sitting on an asset that just got a 45% upward revision in its projected cash flows. And it's trading at $1.63. Keep watching. I'll give you the name in just a few minutes. Before I reveal the name, let me explain how this company actually makes money, because the way they mine uranium is a massive competitive advantage. Most people picture uranium mining as digging giant open pits, expensive, destructive, slow. This company does something completely different. They use what's called ISR mining, in situ recovery. Instead of digging up the ground, you drill wells. Pump a solution underground that dissolves the uranium, then pump that uranium-rich solution back up, process it, and package it. The result is one of the lowest-cost uranium production methods in the entire world. Lower costs mean higher margins. Higher margins mean more cash, even when uranium prices are moderate. And their flagship operation is already running, already producing, already selling uranium to nuclear utilities under long-term contracts. That's not a promise, that's not a projection. That's happening right now. They also just advanced a second project toward production, which means they're building out 2 operating hubs simultaneously. More capacity, more output, more leverage to rising uranium prices. Now, I've been teasing this long enough. The company is Roar Energy. Ticker symbol ERG, trading on the NYC American Exchange at approximately $1.63 per share. Your Energy, a domestic U.S. uranium producer, based out of Wyoming, operating the Lost Creek ISR facility, one of the largest and lowest-cost uranium operations in the United States. And when I show you the numbers behind this company, you're going to understand exactly why multiple Wall Street analysts have slapped buy ratings on this stock. Let's get into it. Q1 2026 results just dropped. Here's what they showed. Revenue of $3.9 million on 55,000 pounds of uranium sold at an average price of $70.98 per pound. Their cash cost to produce that uranium? Just $37.51 per pound. That's nearly a $33 per pound profit margin. Production was up 48% compared to Q1 of last year. That's not a small jump, that's a company that is genuinely, meaningfully ramping up. And they ended the quarter with over 417,000 pounds of finished uranium inventory ready to sell. But here's the number that really caught my attention. Their flagship property, Lost Creek, just got a major technical update. The estimated net cash flow from that mine is now projected at over $442 million. The previous estimate? Under $304 million. That's a 45% upward revision on the same mine. And the CEO made it very clear, they've barely scratched the surface of what Lost Creek actually contains. Oh, and the company is sitting on $122.8 million in unrestricted cash. For a stock trading at $1.63. That is a serious cushion. Now let's talk analyst targets because this is where it gets really interesting. Canaccord, one of the top resource-focused investment banks in North America, just initiated coverage with a buy rating and a price target of $3.25. They called the stock compelling for investors who want uranium exposure. Roth Capital? Buy rating $2 price target, and they just raised it from $1.70. H.C. Wainwright, another longtime uranium analyst, has a buy rating and a $2.30 target. Every single analyst covering this stock has a higher price target than where it trades today. Some are 15% higher, some are over 40% higher, and Canaccord's Canadian dollar target converts to well above the current US price. Now, does that mean the stock is going straight up? No. Small cap mining stocks are volatile, and I'm going to show you the risks right now. Here's what you need to know going in. First, they're losing money. Q1 EPS came in at -7 cents, worse than the analyst estimate of -4 cents. And full year 2025 revenue dropped from $33.7 million to $27.2 million. They are burning cash while they ramp up. Second, dilution. The company recently did a $120 million convertible notes financing, and if those notes convert to shares, existing shareholders get diluted. Third, uranium price risk. This stock lives and dies by the uranium spot price. If uranium pulls back hard, URG pulls back hard. These correlations are tight. And fourth, volatility. This stock dropped 13% on earnings day, then ripped 12% the very next day on the operational update. If you can't stomach those kinds of swings, this is simply not the stock for you. I'm not saying avoid it. I'm saying go in with your eyes open, with a position size you can sleep with, and a thesis you actually believe in. So let me bring it all together. You have a macro tailwind, nuclear energy demand accelerating because of AI, energy independence, and the global clean energy push. You have a domestic U.S. producer with a serious policy advantage as the government pushes to source uranium at home. And you have a low-cost mining method that protects margins, even when prices fluctuate. You have a major upward revision on their flagship asset, $442 million in projected cash flows, on a mine that hasn't even been fully drilled. You have $122 million in cash on the balance sheet. And you have multiple analyst buy ratings, with price targets ranging from $1.85 all the way to $2.30 and beyond on a stock trading at $1.63. Is this a sure thing? No. Is this speculative? Yes. Is this the kind of asymmetric opportunity that most retail investors will sleep on until it's too late? I think so. Your energy, $1.63. Do your own research, size it appropriately. But if you've been looking for a uranium play, that's already in production, already ramping, and sitting at a price that gives you real upside. This one deserves to be on your radar. If this video gave you value, you know what to do. Like, subscribe and drop a comment below, telling me what other stocks you want me to dig into next. I'll see you in the next one.